Welcome back to our second presentation on stocks. Exciting stocks, sexy stocks, risky stocks. And we're going to discuss some places that stocks are sold and some characteristics, numeric measures of stocks. So let's get started on slide number 18 with securities marketplaces. Securities? Yeah, that's the group of financial investments that stocks are a part of. Bonds, mutual funds, options, and futures. These are all securities, which is a really unfortunate term because people think you're talking about, administration of justice or police or something like that. No, not that type of security. It's called the Securities and Exchange Commission. And so the securities, the stocks, bonds, and all the other financial investments, are sold originally only on exchanges. And the granddaddy of them all, starting in 1792, was the New York Stock Exchange. Actually, the Philadelphia Exchange was done before the New York Stock Exchange, but now New York Stock Exchange is much bigger than the Philadelphia Exchange. For 200 years, this was the granddaddy. Well, something came along to sort of spook them, and now they are owned by a derivatives trading firm in Atlanta. Huh? You know what? Derivatives, they're more securities that are really dangerous. Stay away from them. But the big board, as it's called, is no longer the only game in town. For decades, they had the little kid down the street, the American Stock Exchange, which is now owned by the New York Stock Exchange. Everyone used to call it the Amex, but they still do. But now its proper name is the New York Stock Exchange American. And you'll still hear some old timers call it the Curb. The Curb? Why was the American Stock Exchange called the Curb? Because that's where it started. Out on the curb. They would look in the window of the New York Stock Exchange, see what was going on, and then we'd trade outside the window of the New York Stock Exchange. No, they're all inside now. It's all computerized now because along came the NASDAQ. Now, they don't want you to know this, but NASDAQ originally stood for National Association of Securities Dealers Automated Quotation System. But they just don't want you to even think of that. They just want to be known as the NASDAQ. And you see, the NASDAQ started as all electronic, whereas the exchanges were these centralized places where people were screaming and yelling at one another. The NASDAQ was completely computerized. And it attracted many of the big tech companies that when they started, they were small, but you may recognize them now. Microsoft and Apple and Google and yeah, right. And so the NASDAQ got so big that now it's a kid brother to the New York Stock Exchange, no longer a little brother. It's still smaller than the New York Stock Exchange, and its size is from just a few very large companies like Google and Apple and Amazon and the like, the Magnificent Seven as they're called now. But now it's a two-horse race between the New York Stock Exchange and the Nasdaq. And the New York they used to talk about this about 20 years ago, and then about 10 years ago stopped talking about it. But now it seems to be happening. The New York Stock Exchange has said, you know what? We're going to start trading all through the night. I think 22 hours, something like that. They'll be down for 2 hours. And I'm not looking forward to this, folks. Why do you need to sell your 100 shares of Home Depot at 3 a.m. in the morning? I don't know, but hey. Oh, there's another place where they buy and sell stocks, but this is the wrong side of the tracks, dear students. The red light district, the bad side of town. And those are the over-the-counter markets, the bulletin board, the pink sheets. Stay far away from these places, folks. This is where the penny scam stocks are sold. Thousands of companies that are not real companies, that are just somebody's basement in Montana somewhere. No, just stay away. I'm not trying to badmouth Montana, but it's just somebody trying to scam you, and so stay away from the pink sheets. They're not actually called the pink sheets anymore. They used to publish this paper that was pink, and distributed around the country. And these people took lessons on how to be rude to one another. They would call each other on the phone and say, I got 1,000 shares of this. I'll sell it to you for 17 cents. And they'd slam the phone down and call them back and say, I'll give you 12 cents for it. Whatever. For hundreds of years, marketplaces were, and still are for the New York Stock Exchange and the New York Stock Exchange American, centralized locations. But I think the only reason they keep the place open is for television, because nobody's doing anything. They're doing a few trades, but mostly they're standing around looking at the television cameras. With today's technology, the vast majority of transactions now occur electronically. And as I said, I think that they keep them open for TV. There's one guy, Peter or Paul, I can't remember his name, but he's very photogenic. He's got white hair and it flows in the back. He's got a great goatee. And they're always showing pictures of him. He's famous because he's always on the floor. And he's really, really dedicated to his job. So one time he got COVID, right? He got COVID during the pandemic and was out of work for a while. And everybody around the country was saying, oh, we hope Paul or Peter, I can't remember his name, my apologies. We hope he gets better soon. And yeah, so there you go. You can work on the New York Stock Exchange on the floor, not do anything, and get famous if you're photogenic. Yeah, I know they would turn the cameras off when they see me. Anyway, let's keep going. Slide number 19. Now, how do we know how the stock market's doing? Well, to gauge the current condition and historical conditions of stocks in general, financial professionals have created various market indices. It's just a list of stocks, folks. That's all it is. It sounds, highfalutin. People say, oh, the Dow went up, the NASDAQ went down. What's going on here? Well, they're just lists of companies. And the second to oldest is the Dow Jones Industrial Average, 1896. Actually, the first one was the Dow Jones Transport Average. Who's Dow Jones? They're the company that publishes the Wall Street Journal. They're now owned by Fox News. Yeah, right. So do you trust them? I don't. 30 of the largest and best known U.S. companies. Yeah, like Apple and like Home Depot and Walmart. And we'll take a look at the 30 companies in a piece called 90 years ago. $10,000 90 years ago. But the one that's more important, in my humble opinion, is the Standard & Poor's 500. This is 500 of the largest companies in the United States. Not the 500 largest companies, because they play around with it a little bit. But basically, think of it as the 500 largest companies in the U.S. That one is more important. Those are the big companies. But what's happened to the S&P 500 is that just a handful of companies have made the index bent out of shape. The so-called Mag 7 used to be called the FANGs. The companies Faceplant and Amazon and Apple and Nvidia now. For a while, Netflix was in there, but I don't know if they're still there. Google, Microsoft. So those are the Mag 7. And they make up, believe it or not, over 30% of an index. 10 companies make up over 30% of an index that has 500 companies in it. So even that is not a very good measure. The next one that you'll hear quite a bit about is the NASDAQ composite. And we look at this one to see how the tech world is doing, because the tech-dominated NASDAQ mostly has technology companies in it. Now, some of the companies aren't tech companies, like Costco's in the NASDAQ, which, that's not really a tech company, right? So it's not all technology, but there's it's dominated by tech companies. So we look to see how the NASDAQ's doing, to see how the tech world is doing. And then there are some that are not as popular, but important, especially when we get to mutual funds in Chapter 14. The Dow Jones U.S. Total Stock Market, what a stupid name. It used to be called the Wilshire 5000, and that's what I still call it. But Wilshire was another company that made these lists, and Dow Jones did something with them, sort of bought them, but then kicked them to the road. And now they call it the Dow Jones U.S. Total Stock Market Index. It's about 40,000 stocks, and the idea here is to have the big companies, the Papa Bears, the medium-sized companies, the Mama Bears, and the small companies, the Baby Bears, to gauge the entire stock market. The Russell 2000 is a popular gauge for small and mid-sized companies. Why? Well, they took the top 3,000 companies and got rid of the top 1,000. So you got 1,001 through 3,000. And so that's supposed to show you what's going on in the small and medium-sized companies. But all these so far have been domestic, United States-based lists, indices. The next two are global and international. Wait a minute, what's the difference? Well, the World Index, which is now being replaced by the All Country World Index, MSCI, you don't have to remember this, but it stands for Morgan Stanley Capital International. They created an index to show how the world was doing. But they did it, 60 years ago, 50, 60 years ago, when the developing world, or what we sometimes call emerging markets, were very, very small. But now they've gotten a lot larger, like Mexico and Brazil and the Philippines and India and China and Korea. So now, and Eastern Europe and the like. So now, instead of just changing the world index, they left the world index to developed economies like Western Europe, United States, Canada, Japan, or Australia, Hong Kong, Singapore, and South Africa, and created this new index that has everybody in it, the All Country World Index. The EFA, as it's called, some people call it the EFI, was designed to see how stocks were doing outside the United States. It still stands for Europe, Australia, and the Far East. But again, they did not update the EFA to include the emerging markets. So now they have this other new one called the MSCI All Country World Index X USA. Who comes up with these names? Somebody getting paid a whole lot more than me. And so the idea is that we're going to see how the stocks are doing outside the United States. And folks, since the Great Recession, the United States stock market has clobbered the rest of the world. It's no comparison. It's unbelievable. But before that, you go back, 50, 60, 70 years, and the EFA and the United States, basically, they went in different cycles and the like, but they basically returned about the same. But the United States has just exploded since then. And we take ourselves for granted sometimes, but we've done a whole lot of innovation in the last 30 years, and some of these companies are bigger than most countries in the world, like Microsoft and Apple and Nvidia. Slide number 21. Have you heard the terms bull market and bear market? Well, there's stories about where they came about, but that's not important. A bull market is when stocks are going up. Investors are optimistic, people are buying, and so the prices go up. A bear market is when investors are pessimistic. More investors are selling stocks, so the stock market declines. Now, we call it a bear market when it loses 20% or more. If it goes down 5, 10, or 15%, that's called a correction. So that's not technically a bear market. Whatever. It's a market downturn. It still doesn't feel very good. But we know, and if you saw the illustrations in chapter 12, you're going to see some illustrations. You're going to see that prices go up and prices go down. And you just have to be ready for it, because I wish I could tell you otherwise. There's going to be times when the markets are going to fall. Oh well. But they usually come back, and if they don't, that means the economy has failed, and we don't want to go there. Okay. Anyway, slide 22. Let's start some analysis. Let's do some stock analysis. Where do we start? Well, author of The Intelligent Investor, Benjamin Graham, who was Warren Buffett's teacher, sadly passed away in 1975, would say, show me the numbers. There are dozens and dozens of numeric measures. Folks, we're going to look at a few. You're going to do a few calculations. There's a worksheet, and they're going to be on the exam. But you're going to see that they're actually pretty darn easy. And once you've learned what they're representing, you just look them up. It's already done for you. Some of the most popular over the years have been capitalization, book value, earnings per share, and price to earnings ratio, and the dividend yield. So these are some of the things we're going to calculate. We're going to find that all you need is a 99-cent calculator. Actually, I think they're $1.25 now. And whatever. Slide 23, capitalization. In fact, I think this is probably the most important thing. Well, there's another one called PE that we'll take a look at. But how big is the company? You know, everyone worries about the price. The price, for the most part, is irrelevant until you get down to the penny stocks. It's the capitalization that's important. And how do you calculate that? Well, you take the number of shares that are outstanding, in other words, how many shares has the company issued, and you multiply that times the current price of the stock. And that's what the company is actually worth. If you wanted to buy that company and take it private and have it all your own, you'd have to come up with that market capitalization. Actually, you have to come up with more, but there's a story behind that. But you usually have to come up with 10%, 20% more to make it everybody's worthwhile. Because some people say, well, I'm going to sell. There you go. Meh. And that you can get, there's a lot of corporate jousting that goes on when one company takes over another company. But as we said, there are three major categories: the Papa Bears, the Mama Bears, and the Baby Bears. Now, I'm changing my view, trying to change with the industry because I'm old. But I still think of a large cap company of anything greater than 10 billion. But now more and more people are saying, no, it's got to be at least 15 billion to be a large company. Medium-sized companies used to be, 2 billion or so, 1 or 2 billion. Now they're saying at least 5 or 6 billion to 15 billion. So that's mid-sized companies. Small companies are anything less than, say, 5 billion, 6 billion. Once you get it below about 100 million, then you get into this area called micro cap. It's still small cap. It's a subcategory. But they call it, that's a really small company. That's micro cap. And once you get above 100 billion, and now more and more companies are there, you get into this subcategory of large cap called mega cap. If you remember mega cap and micro cap, that's great. If you don't worry about it. Make sure you remember large cap, greater than 10 billion, medium size, mid cap, 5, 6 to 15 billion, and anything below 5 billion, small cap. Now, penny stocks, we shouldn't even mention in polite company. They're usually not worth much more than a few $100,000, or if that. Some of them are worth more, but just stay away from these things, please. So let's do a calculation. Slide 24. Price is $50. How much is the company worth? Well, we don't know until we've looked at the number of shares. So there's 2 million shares outstanding of this company. So $50 times 2 million shares is a market capitalization of $100 million. This is a small cap stock. The stock price, as we said, for the most part, is irrelevant. You must look at the market capitalization to show what the value of the company is. We'll see some examples when we get to numeric measures. Okay? So the next one is book value, slide 25. Sound familiar? That's the net worth of the company. You take the assets, subtract the liabilities, and what you're left over in the world of accounting is called stockholders' equity, ownership. But in our class, we call it net worth. You then divide that by the number of shares outstanding, and that's called the book value. What is it worth on the books? Well, it's very rarely close to the stock price. It's usually 1/5 or 1/6 or 1/100th of what the market capitalization is worth. Why? Well, it only makes sense. A successful business is worth much more intact than if it is liquidated. Think of a pizza shop. How much is it really worth? The pots, the pans, the pizza oven's the most expensive part. But if you were to sell off all the assets, pay off the debts, the fact that it's a successful business makes it worth far more than the assets that are on the books. Now, when the stock price becomes lower than the book value, assuming that the assets are really worth what the accountants say they're worth, then there's a real danger of the company being rated for their assets and put out of business. The corporate raters, the private equity takeover artists, they go by various names, but these people will swoop in, buy 50% plus one of the shares, which means they're in charge, and they will liquidate the company. They will liquidate the company and sell off all the assets and walk away with money in their pocket, they hope. And now how would you feel about that? If you had worked there for 22 years and all of a sudden you're out of a job, you would not be happy. You would go to your elected representative and scream and holler, and maybe he or she might give you some lip service and say, we need to do something about these corporate takeover artists. But the economists and the corporate takeover artists, if they felt like giving you the time of day, would say, no, you don't understand. That company, that capital in that company was locked up in an unsuccessful business. We need to unlock that capital. Maybe think of the plowing under the field, right? The crops that are no longer doing well. And getting that capital, including you, the employee, into a better position to serve the economy. I know it sounds like an advertisement, my apologies, but that's the idea. And that's why, dear students, we have unemployment insurance. We don't have unemployment insurance to pay people not to work. Don't listen to any demagogues who say that. No, it's because we want people to find new jobs and be better employed in businesses that are better serving our economy. It's not perfect. Nothing is we humans have ever created. But as we said, capitalism might be the very worst economic system ever created, except for all the others. Yeah. Okay, I can be careful. I can talk about this stuff far longer than any reasonable person would ever want to listen. Slide 26. Now, these two are very important. Earnings per share. How much is the company earning on a per share basis? So we take the total earnings and divide them by the number of shares. And what many investors will do is look for growing earnings. We want to see the company growing their earnings because that means they're succeeding and doing better in the marketplace. And then we'll take those earnings and relate them back to the price. It's a very simple ratio, but it is talked about ad nauseum in the investment world. And that's called the PE ratio, not physical education, price to earnings ratio. You take the price of one share of stock and divide it by the earnings of the share of stock over the last 12 months. And then you'll see some people say forward earnings. That means they're estimating because they don't know what they're going to make in the next year. They're just estimating they're going to make this. So that would be more speculative PE. But the PE that takes the last 12 months, yeah, that's because that's history. We know that already. A lower PE means the investors are not as excited about the company, but in general, it means the stock is less risky. A higher PE, in general, means that the investors are very optimistic about the company's prospects, but it also signals a more risky stock. Okay, so it's a push me, pull you, a tug of war. Do you want to eat well or do you want to sleep well? So we're going to watch the PE of several companies in just a few slides. So stick with us here. Why do we want to own a business? Because businesses are in business to earn money. And what are their earnings? Now here's an example. The company earned $2,500,000 last year. Is that a lot of money? Well, to you and me it is, right? But we don't know until we know how many shares are outstanding. So here are 5 million shares outstanding. So you take 2,500,000 divided by 5 million and just cross off all the zeros and you get 50 cents. So every share, you could think of like a little fabrica, a little factory churning out 50 cents every share. Think about it that way, right? Yeah, because that's on a per share basis. And now let's relate that to the price on slide 28. If the price of the stock were $10, you would take the price, $10, divided by the 50 cents per share, and the dollar signs cancel, by the way. I hate that word, but that's what we use in math. And you wind up with 20. Is that high? Is that low? Well, it's used to be very high, but now it's pretty normal. By the way, don't put a dollar sign or a percent sign with PE. If you do, we're not going to count it off. We're not going to market wrong or anything, but PE is unitless. So you'll just see people say 20, and sometimes they'll put the dollar sign there. Go right ahead, but don't put a percent sign there. That doesn't make sense. Okay, slide 29. Historically, a PE ratio of 20 or above was considered high, reserved only for the fastest growing stocks. A PE ratio of 5 to 15 was considered average. Well, for almost 30 years, a PE of 40 or 50 was not uncommon amongst growth stocks. The Starbucks of the world, now the Googles of the world. And during the internet bubble, I'll never forget, this was 1998. I looked down and I saw on the Quotron machine, which are gone now because of the internet, but these were machines that were hooked directly to the exchanges. eBay's PE was 10,000. And I said, this isn't going to last. I don't know how long it's going to last, but it ain't going to last. And a year and a half later, in 2000 is when, this was late 1998, is when it started falling. PE ratios fall dramatically when the markets fall. Now PEs are up again for many companies. Many companies have very high PEs, but others not so bad. So it's kind of a mixed bag. The PE ratio essentially tells you what the market believes the prospects for a company are. And so a higher PE, as we said, people are more optimistic, but there's more risk involved. A lower PE, people are not as optimistic, but in general, there's less risk, or maybe the company really is not doing very well, and people are just saying, I don't believe you guys are going to be around in 5-10 years. So it's part of the judgment that we need when we choose individual stocks, as you would see in Business 123, Introduction to Investments, which we want you to take next semester. Okay, dividend yield. Dividends don't lie. Loves dividends. This is the yearly dollar amount of income generated by stock divided by the current market price. As we said, historically yields were in the 4 to 6% range. Now you can find 2 to 3%, but a lot of companies aren't paying any dividends. The growth companies are not taking that money and distributing it to their shareholders. They're reinvesting it back in the company because they're growing. This allows us to compare the stocks to other investments, such as a savings account or a bond. So dividend yields are important for many investors, and other investors say, I don't want dividends. I want the stock to go up. So don't bother giving me that money. Give it, put it back in the business. Or what some companies do is they buy back their own shares, and that reduces the supply. And you economics students will know that if you reduce the supply and the demand doesn't change, right, what's going to happen to the price? Yeah, the price is going to go up. So that's the game that many people play. I like dividends. That's me. Okay, so last calculation. If our dividends per year are $1.50 and the market price is $87.50, we would take the dividends per year, $1.50 divided by $87.50, and this is 0.017142. Well, we would write it as 1.71%. Don't round it up to 2%. Not that it's wrong. It's just that we like to see at least 2 digits to the right of the decimal point, sometimes even 3, but 2 digits is enough. That's called the precision, the digits of accuracy, right? The significant digits, as the chemists would say. So use at least 2 digits to the right of the decimal point. 1.7 is, it's not bad, it's not great, but it's certainly better than some stocks. So, and it's better than a lot of savings accounts, which are paying 1, maybe 2%. So, but what's the difference? The savings account is guaranteed by the bank, which is guaranteed by the federal government through the FDIC or the credit union, NCUA. The stock price could go to 50 tomorrow, or 20, or go up to 100. And stock investing is volatile. It's risky. Yes. Okay, so now that you know those measurements, let's take a look at some companies you may or may not have heard of Have you heard of these two mom and pop shops, Walmart and Costco? Well, as of October 24th, the price of Walmart was $83.04. The price of Costco was $893.42. And if you just looked at the price, you might think the Costco is worth more than Walmart. Now, wait a minute. Intuitively, who do you think is bigger? I think if you've been paying attention that Walmart is bigger, and it turns out it is. Yeah, it turns out it is. We'll see. Hang on a minute. What's the earnings per share? $1.92 for Walmart, $16.54 for Costco. So you divide the price by the earnings, and you get 43.2 for Walmart and 54 for Costco. Those are very high PEs. Investors are very excited about the prospects of Walmart and even more excited for the prospects of Costco. Well, these two are in a serious competition along with Amazon to go worldwide. One of the most fun things you can do if you know Tijuana at all is your friends who are terrified of going to Mexico. Say, oh, don't worry, I'll take you to one of the most dangerous places in Tijuana, North Tijuana, but I'll be there with you. I speak Spanish and we'll be going there during the day, so don't worry. And then we drive, and in 30 seconds after you cross through the gates, you're at the Costco. And they look at you and they go, "This is a Costco." I say, "Yeah, you want to go see the Walmart? How about the Home Depot? You want to go to Carl's Jr. or the McDonald's?" And they go, "Very funny." Okay, what's the book value? Well, look at that. $10.51, $53.31. It's 1/10, 1/20th, much less. In other words, investors, they don't care about the book value. They know that Walmart and Costco are very successful companies, and they're never going to want to liquidate the company and sell off the assets, pay off the debts. They want the company intact. Dividends per share, 83 cents for Walmart, $4.64 for Costco. And so that means that the dividend yield for Walmart is 1%, and Costco it's even less, 52.52, 0.5%. So, are investors buying Walmart or Costco for the dividends? Not really, no. They're buying them because they believe they're going to grow, and as they grow, they'll earn more and the price will go up. That's usually how it works, but not always. But here's the money pitch here, folks. What's the market capitalization? $667 billion. Yeah. You see, the price of Walmart is a whole lot less, but there are 7 billion shares, I think, of Walmart and only like 800, 900 million shares of Costco. So the market cap of Walmart is 1.5 times that of Costco. Costco, no slouch, $396 billion, almost $400 billion in market capitalization. So if you wanted to own Costco, if you had $400 billion in your pocket, you could walk on down to they're on the NASDAQ, and say, "I want to buy." Well, it doesn't work that way. No, folks. There's a set methodology for when one company or one individual, usually not one individual, wants to buy another company. You might have heard of Elon Musk buying Twitter. Yeah. He had to raise the cash from other places. He didn't sell. He could have sold a lot of Tesla stock and just bought it outright, but he didn't do that. He borrowed a lot of the money and paid over $40 billion for it. And most analysts now say it's worth about $10 billion. And they're losing people. So would you want to own Bitter? Oh, next. X. Yeah, it's not called Titter anymore. I still call it Titter. Okay. How about McDonald's and Yum Brand? Yum Brands, who are they? Well, you know them as Kentucky Fried Rat, Taco Smell, and Pizza Crap. I'm sorry. Kentucky Fried Chicken, Taco Bell, and Pizza Crap. Pizza Hut. They own a few other restaurants. I think Long John Silver's. They originally called themselves Tricon, which was a really dumb name, but the symbol was so cool. The symbol was Yum, Y-U-M, right? It was spun off from, of all people, PepsiCo. It was spun off by Pepsi in the late 1990s. And so everyone said Tricon, so they changed their name to Yum Brands. Folks, McDonald's, Yum Brands, all those others, fast, bad food. you can make a whole lot of money selling people sugar, salt, and fat. And then we'll sell them the diabetes drug. Privatize the profits, socialize the costs. Anyway, so McDonald's was $301.58 on the 24th of October. Yum was $133. Earnings per share $11.41 for McDonald's, $5.45 for Yum. So the PEs are fairly close to one another. And not really high like Costco and Walmart, but still pretty high. 26.4 for McDonald's, 24.4 for Yum brands. Look at those book values. Negative book value. What did they do? Well, when money was really cheap, they could pay 1% or 2% for a 30-year loan. They just borrowed a ton of money. Now, what did they do with it? They bought back a lot of their shares. Probably they're keeping some of it to build out more stores around the world. For a while there, dear students, Yum Brands was kicking McDonald's butt in China. So much so that Yum Brands spun off their Chinese company because it turned out that the Chinese had more of a taste for chicken than they did for beef. But McDonald's is McDonald's, and they actually don't make as much money off the beef. They make more money off the potatoes. So that's why they say you want fries with that, because that's where they make their money. Is anybody going to try to? No one's going to try to buy either of these companies. Dividends per share $7.08 for McDonald's, $2.68 for Yum. So the dividend yield for McDonald's is almost 2.5%. Not bad. 2.4, not bad. Yum is a little less, 2%. Not great. I like at least 3-4%, but that's me. What's the market cap? Well, notice McDonald's is over $200 billion, $216 billion. Whereas Yum Brands is still a pretty big company, but nowhere near as large as McDonald's, $37.4 billion. Like 1/4 the size, 1/5 the size of McDonald's. But they do well around the world, folks. People like that Kentucky Fried Chicken? Yeah. I apologize. The stuff turns my stomach when I ride by on my bicycle and you smell that grease. But people love that. They love that. It's good for you. It coats the insides of your arteries. It's really, really good for you. Anyway, slide number 34. Our last comparison. A couple of companies you may have heard of, AT&T and Verizon. Well, now, let's see. $22 for AT&T, $41, almost $42 for Verizon. You think Verizon's bigger? Well, it is a little bit, not much. When we look at the market cap, we'll see how big they really are. Earnings per share, $1.23 for AT&T, $2.31 for Verizon. Notice the PEs are they're exactly the same. If we went out a few more digits, we'd see that they're not exactly the same, but 18.1 is rounded up. Are investors excited about the prospects for AT&T and Verizon? Well, they are more excited than they were a few years ago when they were in the single digits. People were not too excited about what's going on with AT&T and Verizon. And why is that? Well, a lot of it has to do with the fact that people already have cell phones. How many more plans are they going to have? They have to steal from one another, which is really difficult. Now, let's take a look at the PE of T-Mobile. You would see that investors are more excited about T-Mobile's growth prospects. I'll let you look that up. There's a presentation on how to use Yahoo Finance or Morningstar or MarketWatch, all these other websites, and some of you have phones, right? Some of you have you might have AT&T, you might have Verizon or T-Mobile. You can just look on your phone and you don't even use a computer. Okay, what's the book value? $14.27 and $22.88, so about half. Remember, the other companies, it was 1/10 or 1/20th or negative, but because investors have really not been too excited over the past years for these companies, the book values, AT&T was getting dangerously close to its book value. Now, I don't know if any takeover artists would try to take over AT&T, but if the value of the assets on the books reflected anywhere near what the accountant said they're worth, it could have happened. $1.11 for dividends per share for AT&T, $2.71 for Verizon. Look at those dividend yields, 4.9%, 6.3%. They are paying more in dividends than many bonds pay in interest payments. Are investors excited about the prospects for either of these? They're more excited than they were just a few years ago. Would you invest in either? Hey, it's not like people are going to give away their cell phones, get rid of their cell phones, but that's the problem. Where's the growth? If you go down to Mexico, you'll see that AT&T is really pushing to get into Mexico. Another company 20-some years ago from Spain, Movistar, tried it, and they're still there, but I don't know that many people use it. But I don't know. I think what they're doing with AT&T is they're shooting for the people who have family in the United States, and so they're talking about, hey, it doesn't matter where you are, Canada, United States, or Mexico. So I don't know if they're having much success with that. Anybody who lives in Mexico, they have friends, because Telmex, Telcel, they're everywhere. Every OXXO, you can charge up your Telcel mobile phone. So that's business, folks. It's competition. And if it excites you, there's a future for you in the business world. And if you'd rather eat barbed wire or watch paint dry, there's a future for you somewhere else. but it's good to know. It's good to understand. I think it's exciting for some of us. Yeah. Okay, so hopefully you are excited, because we're going to continue with our third presentation and learn even more about stocks. Are you ready? See you in our presentation number 3, where we will learn about some stock investing strategies, and then look at some places where we can get information about stocks, right? Okay. Thank you so much for being in our class, dear students. We are proud of you. Think about how much you have learned.